think Steve and Will, a couple months ago, they reached out to me and Brad and asked me if I would come up here and provide some just broad hog outlook, and specifically focus on maybe what do these different hog operations look like? Specifically, what is this? A lot of people are talking about farm income, but what is specifically, if we choose to go into a certain type of hog operation, how does this affect farm financials? And then specifically, if we have a row crop operation and we're thinking about adding another hog operation, what does that look like? How does that affect farm financials? So I'm going to go briefly over just kind of some hog outlook, maybe talk about some questions that I think about when I'm thinking about risk, both financial risk and production risk, and then we'll kind of go into some really nice data that spans for about 12 years within the Midwest and looks at about 400 different hog operations. So wouldn't be an economist without putting up like a basic graph, and I think as economists we need to do a better job at communicating this. There's a lot of misconceptions about what demand and supply is and is not. So when we're talking about demand, we're talking about people who are willing to purchase a certain amount of quantity at certain prices. And then as producers we decide, okay, do we want to produce at a certain level of price? And so when we do that, we find market equilibrium. So when we're seeing that market price, people are finding, okay, they're interpreting that from the retail demand, and then we're going, making production decisions. But specifically when we're talking about changes in demand, so when we're talking about when we're trying to develop infrastructure, we're trying to increase supply, that needs to be demand driven. And so things like prices going up is not a change in demand, that's a change in what we call a quantity demand. We're moving along this curve, but it's not actually shifting out that curve. So when we're talking about demand, demand is not volume sold. When we're saying production is up, that is not, demand is strong. Volume sold does not mean demand is improving. We're moving along that curve. Demand also isn't per capita consumption. We'll talk, a lot of people say, oh, per capita consumption is up, and say demand is strong. Per capita consumption isn't demand because it's a purely quantity measure. Once again, we're moving along that curve. So just want to make sure we're all on the same page as we move forward. So we're talking about what shifts demand. We're talking about how do we improve, is demand for pork or meat products in general, both domestically and abroad, is demand actually improving? We look at certain key metrics as economists. We're looking about what does that customer base look like? Are we, is there increasing demand for, domestic production, in our export markets? We also have to recognize that we're producing product for people who have different tastes and preferences. People who are following the different markets of never ever antibiotics, or a lean product, even looking at some quality grade on different pork chops. We're trying to find ways to produce products for producers or for consumers. And then we're thinking about income. What is the general economy looking like? So people who have more disposable income, or as incomes go up, people start purchasing more protein products. And so when we're looking at, okay, is demand going to be increasing? We're looking at things like, what is the state of the economy? Are people going to have more money in their pocket? And then also the price of related goods. If for instance, the price of beef goes up, people are going to substitute away from beef products, and they're going to go into different products like pork and chicken. So when we're looking at, what is driving this demand, these are some of the broad things that we're looking at. This is a chart that is put out by the USDA, and it talks about what is this strength of demand. And so you can see that we have this, there's this index that they monitor over time, and it really kind of helps us gauge, is demand improving, is demand kind of decreasing? And this is on an annual basis. So just kind of 2 points here. In 2013, we saw this large ramp up, 2013 to 2016, and a lot of hog producers, noticed, man, we started to improve. Those were great years. Well, a lot of that came because we're increasing demand by almost, 14%. So when we're talking about, what is driving markets, demand, allows us to produce. Consumers tell us, demand products and they say, should we produce this product or not? The science or the supply side is, can we produce that product or not? So the way we can interpret that is let's say in 2015, where it's 95%, saying if demand were as strong in 1990, or if we had demand like we had in 1990, in 2015, we would have produced 5%. We would have produced 5% more beef, or sorry, of pork. So here, when we had pretty low demand for pork, set almost 80% of the demand from 1990, was not there. And so we can follow this over time and saying, are we improving demand? Obviously, we can get much more disaggregate, and demand is seasonal for the pork products also by week and by month, but saying that, this number is really more jagged that. So when we're talking about production decisions, when we're talking about, marketing decision, this demand, what is that demand looking like in that certain week? And then we talk about population bases, where is this population growing? 30%, almost 30% of all the pork grown in the U.S. is exported. So when we're talking about developing export markets, this is it's a very important thing when we're talking about, improving, the profitability of pork producers within the U.S. No surprise, a lot of that current population is over there. So when we start talking about trade, or we start talking about production or production risks, African swine fever, we're talking about how is that affecting consumption and demand in these areas. You'll hear the growing middle class, people are getting more disposable income to start purchasing better quality protein products. But over time, that's where we're at now. Right here, 2019, what is this going to look like moving forward? So as we start to say, where are we going to develop these export markets? We have current export markets. Where are these export markets going to develop, and how are we going to change, that type of product that we're producing? We see that, a lot of that growth is still going to happen in Asia, but, Africa to a greater extent moving forward is going to be a large player in that. Just kind of making ourselves aware that this opportunity for growth, this opportunity expansion is out there. And it's increasing our product base and recognizing that that base is going to be increasingly overseas, not necessarily domestic product. So we're talking about this demand. We can look at these. What does export demand look like? That same kind of chart that I showed you before with domestic consumption. In 2010, to 2019, we've had almost a 50% increase in pork export demand. That's huge. And so as we look, the profitability going forward, and we look at opportunities moving forward, continuing to develop and make sure that export demand remains strong is a key determinant. We're looking about each year, the USDA puts out what they call their projections. What is this going to look like in 20 years? Obviously, we can't forecast out 20 years, but they try to say, kind of give a broad economic indicator for producers. And we recognize that, all the meat products show very positive growth going forward. And so when we're talking about looking at opportunities to, add operations, or is there going to be demand? Demand is going to be there, but it's probably going to come in the form of export demand. It's not going to be in the form of domestic consumption of pork products. And so when we're talking about the export demand, the thing that we need to make sure we're understanding is that this, the exchange rate, all these things drive, as things get more expensive to import, these, export demand goes down. So, as things get more expensive or cheaper for us to ship over there, we can see those different types of demand and supply relationships. A lot of you are familiar with these prices over time, but they're trending upward. But people continually spend about the same amount of their disposable income. So even though prices are creeping up a little bit, the dollars per pound that people are at the retail meat counter looking to pay, the amount of money that's coming out of the U.S. consumer's pocket each year, each month, each time they go to the grocery store is staying pretty much the same across all the meat products. So, beef, it's about 2.5%, pork, it's about 1.5%, and same thing with poultry. So this further emphasizes the idea that, a lot of this demand, a lot of this increase in product is going to come through exports. So we're talking about, okay, that demand is out there. Okay, what do we need to do to build production within the U.S. in order to meet that demand? So we're talking about, what do we need to do in order to shift this supply? Okay, demand is shifting out. Okay, we need to now capture that increase in demand by improving production. So when we're looking at, supply, we're looking at, what are the prices of production? What is that, that market hog worth? What is the technology? Are we putting more pounds on fewer animals, or are we putting it on across more animals? And then just recognizing that there's these natural events that happen that really have dramatic impacts, both in the short and long run in supply. Disease, weather, start thinking about, and we talk about, as people see, wow, there's opportunities to be out there. More people enter that market. So think about like the export market. We're not the only ones shipping to Japan. We're not the only ones shipping to Mexico. People see those opportunities and they start to compete with us. And so when we're talking about profitability, we're trying to maintain that low cost of production, which the U.S. has done a great job at doing. So we're talking about, when we're looking at these market hog prices, we have to recognize that, when we're looking at a price, just because, it's a, $1.20, in June compared to, 95 in January, we have to make sure we're looking at it in the context of where are we at in the seasonal patterns. So when I say, are we above that seasonal pattern, or are we below that seasonal pattern? And so when we're looking at, okay, what is these prices telling us? We just make sure we're thinking about it in that sense. So when we're looking at, what is these prices going to look like over this 20 years that USDA puts out? We're looking at a pretty much flat, price for hogs, market hogs over that time period. You'll see this steep decline. They've reached a peak in the beef cattle industry. They think that those prices might not go down and relatively flat for poultry consumption. So we're talking about how efficient are we on putting pounds on hogs. This is incredible. I think this is like probably one of my most favorite chart of this this supply section, because this is incredible. When we're talking about from 1994 to now, we've almost doubled the amount of pounds, put out by breeding hogs, and that's incredible. We've become extremely efficient at feeding hogs and hog production, because we're trying to meet that demand, and we'll continue to develop new technologies. We'll continue to develop new ways of feeding and improving those average daily gains and those feed conversions, and that number will continue to go up. That's impressive, and you all should be commended for that. So we're looking at where does this hog production take place within the U.S.? There's lots of places we can produce hogs. Where does this hog production take place? We're right here in Nebraska, and not coincidentally, our neighbor over to the right of us, Iowa, produces the lion's share. But we're looking about all this Midwestern region where all our farms are going to be taken from. We produce a lot of hogs there, but that's in 2008, but how much have we expanded this production over time? Well, Nebraska has still improved production, but not at the rate that other places have improved their market hog production. So that's about 90,000 head from 2008 to 2018 that we've changed over a 10-year period. Our neighbor to the right, that's about, 3,500 hogs, that they've or 350,000 hogs that they've improved, and other places, they're also expanding. So when we're thinking about this in the context of the demand is there in the form of export demand, and we're looking about, what does this look for us for supply. Other people are improving supply, so there's opportunities to continue to play in that space. And then we're looking at production. We talk about there's different production risks that we need to take on. The one that obviously people are talking about right now is African swine fever in China. What does that look like? What are actually those numbers actually being reported at? And how is that going to affect both their domestic consumption, and how is that going to affect potentially us moving forward? A lot of this pork is being reshifted around in the export market because of that. They still need to eat their pork products, and so we're able to find different markets for that. But these production shocks, they're going to be both in the short run, long run. We're going to see an immediate impact of ASF, but in the long run, are we going to develop capacity to enter those markets again? So this is an idea of, we hear about ASF, but where is this actually happening? These blue dots are outbreaks that happen, but then were resolved, and these red are continuing outbreaks. So it's not, and this was in, these are all with, this was in the past year, or sorry, past month. And when we're looking at that, we're saying, wow, this is not just like we observed it once, and I guess it's there. That is there, and it's still very active. And a lot of people talk about, what does that mean for U.S. hog production, if or when it gets here. And so when we're talking about, okay, we're trying to meet this demand, we're trying to say, okay, well, people are also trying to compete in our market, while we, that comes in the form of exports, but we're not really changing, the export doesn't look that different, but we are trying to improve this export market. This dotted line represents 2018. You see that we were on kind of record export markets. March, right here, as you'll see, is that's when we started having our trade disputes, and then this is what happened. We've been able to rebound just a little bit, but just kind of giving the effect of, it still followed the same seasonal pattern, but that drop-off should have been more like this. So this is, what we say lost value in the market because of that. So those things like trade, as we start to negotiate the things, they can have a big impact upon. Now all that hog production is staying within the U.S. We have to find a home for that. We have to find, places where people can, export that market, but people can only consume so much pork domestically per year. What do these places look like? We're talking about major export markets for pork production. Japan, Canada, Mexico. We're looking at, look at how much we've improved our production, to Mexico. I mean, it's becoming extremely important, to have good relationships with, both Canada when we're talking about USMEF, NAFTA 2.0. We're talking, these are extremely important markets for pork production. But also, Japan, as we increase our ability to supply that red meat market. So we're talking about this trade. We're talking about what is this impact upon us. We know that pork production demand is in the export market. There's some domestic production that will continue to increase, but most of that demand is going to happen in the export market. So as we we're looking about, what is the impact of entering into one of these agreements? When we're talking about, these meat products, we're talking about, a 1.5 to almost 2% increase in export demand just because of a trade agreement. So when we're talking about hog production, we're talking about, where does this product go? A lot of that happens through these different trade agreements. So continuing to try to work to ratify those agreements and, potentially entering into different other agreements that we withdrew from, such as TPP. All of those things become, a greater impact. When we're talking about, what was that impact because of withdrawing from TPP, or if we don't have USMCA, we're talking about a reduction about, about 1% in hog export. So continuing to work with people to try to get these done will continue to be important issues moving forward for the hog industry. So we know, okay, now we know that there's production out, demand out there in form of exports. We know that supply, we grow great hogs, we can supply that market, exports are increasing, we're able to have those homes for those places. Kind of talking about what are these risks that we're going to take on. Don't need to belabor this issue, but I think it's just good reminding ourselves that we work in a risky environment and there's many types of risks. I tend to enjoy kind of playing in the production and price risk, but there's many other risks, a financial risk. We can go on. We have trade risks. Obviously this past winter we recognize that it's with the flooding and then with PRRS, these disease risks. We work in a very what we consider a risky environment. There's a lot of things we have to manage as producers. So I think it's just good just to have some introspection about this. What risks am I willing to tolerate? What risks am I not willing to tolerate? And having that honest conversation with ourselves, because then if we know that, then we can start to say, what are our strategies moving forward? Okay, I don't want price risk. Okay, if you don't want price risk, this is what we need to do to take out price risk. And it's saying that, well, if I take out one thing, I'm exposing myself to other types of risks, and recognizing that these risks can be offset. So some of those things, risk spreading types of insurance products. Or, the futures market, we don't want price risk, so we're going to take on basis risk. Or we're talking about diversification, which I'll focus the rest of the presentation on. So, we're talking about, I have a row crop operation. So what does that mean for me as far as like if I want to add a hog operation? How is this diversification going to help spread out that risk? And I think it's important. We tend to think, when I talk to people and producers, tend to think of it more as a binary. Will it happen or will it not happen? And really kind of trying to push this to saying it's not whether something will or will not happen. It's what is the likelihood of that happening. So what is the likelihood that ASF is going to come? Not will it come or not come. It's what is that likelihood? Because then when we know the likelihood, then we can say, okay, how do we manage that? Something could be possible, but it's not very likely. Then we probably don't need to manage that type of risk. And just kind of recognizing that there's opportunities to place your money, and just recognizing that based upon what I present, if that's choosing to kind of expand into a hog operation or not, but just kind of knowing what is the value of your next best option? What do I need to do in order to continue to improve my farm income? And how does that look like for me going forward? So now we'll kind of talk about, you can't really see this, but the 2017 Ag Census just came out. And I wanted to kind of first go over what does this hog production look like in the US. So I guess I'll have to explain this to you. But so this is this column over here is farrow to feeder. This column here is farrow to finish. This is farrow to wean and finish only. And here we have this is by number of farms. This is 1 to 100, 100 to 150, 1,000 to 5,000, and 5,000 plus. So we see that on a lot of these, we still have a lot of small producers, both across the supply chain. And of course we have these, this is farrow to finish, so quite a few people under 100 head here. But what does that look like? Those are a number of operations, but what does that look for capacity within the U.S.? When we look at the number of pigs that each of these operations, supplies, it's breathtaking. Once again, farrow to finish, or farrow to feeder, farrow to finish, farrow to wean, and finish only. Most of this production happens in the 5,000 head plus capacity. While there's a lot more operations in these kind of smaller head capacities, most of that is 5,000 plus operations within the U.S. Now, what does this look like, hog production within Nebraska? So we can take that Ag Census data, and then we can say, okay, where is hog production actually taking place in Nebraska? So I showed you these aggregate numbers for the U.S., and we can look at what does this look like for hog production within Nebraska by county. And specifically, how does this change over time? So in 2002, this is kind of where our hog production was. These are broken in by, we'd call quartiles. So these red, very, very dark red is between, you can say about 125 operations within each of these counties. A lot of that concentration right here, not surprising. But, what is it? How does that change? How did we change production from 2002 to 2017? A lot of that production stayed within here, but we are also expanding out here. So a lot of that production, while we're continuing to focus, kind of adding operations, other counties, other places are finding, hey, we can set up these operations too. So what does it look like for inventory? Just like we said, these are just the number of operations, but what about the quantity of pigs that we're feeding? 2002, a lot of that was here still focused in that northeast corner, and it intensified. So even though other places are improving they're adding hog operations, the bulk and the intensity of that feeding continues to happen right here where we're at. So I think it's fitting that that we're here, and it's great because this is really where the packing plant over in the eastern corner. We can continue to provide that product. So now that we see where that production is, now we can look at what do these different type of operations look like. So what I'll be showing you over about from 2008 to 2018 is we're going to look at some farm financial data that spans across the Midwest. We're talking about Minnesota, we're talking about Illinois, Nebraska. So all of these farms are going to be together, and we're going to break it down by 3 different type of operations. We're going to talk about independent producers. This person's going to take on all the production risk, all the market risk, and they're going to have to raise that animal, take on the morbidity and mortality, and then sell that animal at the market price. Then we're going to talk about contract growing, people that build the barns, they provide the hogs, and really you're there responsible for all the operating costs, utilities, labor, etc. And then just this contractor integrator, they own the hogs, they're purchasing and delivering all the feed, and they often own several stages of production, such as a packing plant. So what does that look like within the U.S. on average? We see that most of that production and the contractees, so people who are building these barns, happens, they're building these barns, there's going to be 5,000 head capacity barns or more. With these independent producers, obviously we're going to have 1 to 100, there's going to be head capacity. A lot of independent producers are in that realm. So what does that look like as far as number of pigs sold? Even though the independent producer, there's lots of the small ones, most of the volume for hog production comes from 5,000 head capacity or more independent and contractee hog production. So what does this look like? So as mentioned, farm financials over time. We can look at what is this, look at different financial performances. So we're talking about what does this affect liquidity? How does this affect our repayment capacity? How does this affect profitability in general? So this is for all crop operations. That's the red. Then green is all hog operations. So it doesn't differentiate by if they're farrow to finish or weaning. So that's hog plus crop, and the blue is just hog operations. So what does this look like on average over this time frame? If people choose to add a hog operation to a crop operation, it really doesn't affect our liquidity. Our current ratio kind of stays the same. In fact, sometimes in some cases it improves. Our profitability kind of stays the same. We're able to turn about the same number of assets. And we're still able, it doesn't hurt our ability or repayment capacity. And so we see some, basically over time, we see that, in adding a hog operation to a row crop operation across these farms that we're looking at doesn't necessarily seem to be affecting, on average, farm financial stress on ability to make debt repayments, and it doesn't seem to be affecting, in fact, some cases improves farm get returned to assets. Well, this one's really going to be hard for you to see. So what does this look like over time? So I showed you that average over a certain time period. So this blue line right here, which I'm really sorry about that, is the hog operations. This red line is the crop operation, and this green line is the hog plus crop operation. So what does that look like on your operating profit margin? So what is this margin? This is 0 right here, and this is 20%. So as we're going through time, this operating margin is gonna bump around. But on average, a hog plus a row crop operation, this line stays in the between, pretty much in between the crop and the hog operation. So it allows kind of that you're not obtaining the really highs, but you're also not getting the lows. It kind of smooths out your operating margin. It can smooth your operating margin out over time. What does that look like to your return on assets? Same thing. You don't get the super high, return on the good years, but you also don't take the bottom part, in really bad years. It really smooths it out. A crop operation plus a hog operation really smooths that out over time. So what does that look when we're talking like benchmarking? So when we're talking about benchmarking, we're saying, what does the top 10% people do? What does the bottom 10% people do? How does this change over time? We're looking at, this, on average, or not, half of the farms, they're still in good financial health across these different, their ability to repay debts, service their short-term loans, which is a big indication of their cash flow, and we are able to have these, consistent profit margins. Oh my gosh, we won't be able to see that for sure. So specifically we're going to look at what does this look like for someone who says, I want to be a contract barn, so the contractee, and I say I want to operate from a wean to finish perspective. So when we're looking at, this is if you are just to be hog operation, if you were to be an independent producer, this is that red bar. And then if you were a hog contract barn, is this green bar right here. So this is in dollars per head. So on average, your labor is a little bit lower, so you're charging yourself a little bit more, but your net return over labor and management, on average, over these 10-year periods, is a little bit higher for a contract barn, specifically for wean to finish contract barns. So we're looking about like what this variation is over time. I want to focus specifically on this chart over here on this far right chart. This is net returns over labor and management. I just showed you that on average, an independent producer over this time period across this farms, was a little bit over break even, but look at this variation over time. Some years it's negative $20 per head. Some years, and mentioned in 2014, it's, over $30 per head. And so this variation over time, extreme, volatility as they're taking the price risk, they're taking the market risk, the disease risk. And then this green line right here, that is contract barn growing. Very stable, as we assume. It smooths out a lot of that variation in net returns over time. So as people are deciding whether they want to add, when we're talking about risk, how much do I want to take on that market volatility? How much do I want to just set a price and just produce? And that clearly demonstrates you are going to take on that market volatility, net return over management labor by being a independent producer. That doesn't mean one's better or the other. It just means that we're exposing ourselves to different opportunities and different risks, and the contract barn kind of growing, stays pretty consistent over time. I'll skip that. So what does this look like when we're talking about, people, this profitability over time, across these different percentiles? We're people who are, once again, this red line is for all the hog barns, the independent producers from wean to finish. And then this is, this green line right here is contract barn wean to finish. So the bottom 10% of people who are, this net returns over management labor, they're losing money. And this is about the 50%. So on average, 50% of people are losing just under break even on their independent hog operation. But then people who are really, really good at, growing their own hogs, they take this increase, they're making lots of money over here. So, really evaluating what are my skill sets, what are my strengths, where can I find opportunities for, to improving that. Because if you're good, that as an independent producer, you can, there are returns to be made out there. And you'll notice that this line is much more flat. So even if you're a pretty bad contract barn grower, which you don't manage your utilities or your costs, even though you're bad, you might not be as good as these top people. The difference between a really good contract barn grower and a really bad contract grower is less extreme than a really bad independent grower and a really good independent grower. So kind of in summary, we talked about that health in the demand is going to come from the export market. We have the ability to continue to supply that market because we can continually put on more pounds on the hog. We can find places for that export market. We're competitive in the export markets. People enjoy eating American pork, and we saw that, where is that inventory looking right in Nebraska? It's primarily concentrated on that northeastern part, but we also see that concentration is intensifying. There's opportunities for continued growth. We looked at different ways that say, okay, on average, if we just have a crop operation and we add a hog operation, farm financials stay pretty much the same. There's not a lot of noticeable difference. Our liquidity stays pretty much the same, and in some cases improves. Some of our productivity as far as net returns over asset or returns to asset, stays about the same. So when we're talking about, okay, can I continue to lock in that margin, expand my operation, potentially bring people back, the opportunities or the data from 2008 to 2018 shows that that's a potential, the profit is potentially out there. Then we looked at, okay, now if we've decided we want to be a hog add a hog operation, what does that look like? And we say, okay, what does that look like depending upon the different types of contracts? And we compared across the independent grower and also across the contractee. If we want a steady stream of income, and that's when we're talking about a risk, I don't want that risk, then that really informs your decision about what type of operation we can add. But if we're okay taking on that market risk, that production risk, and over time, we might be more comfortable being an independent producer. And while 50% of people may not make money, or break even, the opportunity to really capture high profits as an independent producer from a wean to finish operation is there. That's all I have today. I would be happy to supply, I know some of these graphs were a little bit small for you to read. I'd be happy to supply this PowerPoint. I can provide it to Steve and he can send it out to you guys. And I'd be happy to answer any questions that you might have, or just maybe just act as a sounding board for maybe some of the concerns or thoughts that you might be having.